Today's workshop is about buying a home. So just a little objective about the workshop. The workshop objectives are just making a financial plan. Also, you can what you can afford and what other financial information you should prepare to buy a house. Financing your home, shop for your home, and make an offer and close on the home and move in. So there are 5 objectives that you're going to work on today. Well, as far as house, there are 5 types of house, and one of them is apartment, co-op, condominium, townhouse, or a single or a multiple family house. It really depends. What are you? What do you want, or what would you like to have? It's something that you want to achieve. It's up to you. Apartments are usually like you just buy an apartment, but there's rules and regulations that you would follow according to the apartment complex. And then also, co-op is basically purchasing a share of a property, resulting in your getting a space in your building. Technically, you don't owe that part. You don't owe your apartment or space. It is governed by the board and makes decision rules of the building. Something is very complicated thing, to be honest with you. And then also condominium is very similar to that. Condominium is just basically you buy a home as well as the share of space and services offered by the complex. Basically, it's your house, but it's kind of work the same as an apartment. Basically, if there's a plumbing issue, there's an office that you can go to and call them or ask for any type of service that you would want to do. And then also a townhouse is very similar to that. It's just houses that are combined together. And then also a single house or a multiple family house basically is a house, but there's a land surrounding of it. So that means you own the property. What are the benefit of owning a house? Well, the benefit of owning a house is, first of all, it is yours. You don't have to do anything about it. Building with wealth and assets. Also, some control over housing payment. Build your wealth and assets again, and then home value will rise. Tax deductions and communities. Basically, what it means by tax deduction, at the end of the year, you can claim your monthly mortgage on your tax forms. And also, if you want to sell your house in the future, definitely you can sell the house because the value of the house will definitely go up. What are the responsibilities of owning a house? Well, the responsibility of owning of home ownership is basically you have to pay your mortgage on time, something that you would have to keep on top of it. Your other bills and fees, such as utilities, tax, and insurance on the house. Home repairment, basically, if you want to do a kind of like a project on one side of your house, or you want to build some of it with one side of your house, you need to do that. And also, if there's any leakage from the pipe, or if anything, you would have to think about that as well. And then also maintenance of the house, such as front yard grass, lawn. You would have to either do it yourself, or you can have the people that comes in and they mow your lawn. Of course, everyone is at a cost of some money. It really depends whoever charges you the least amount. Making a financial plan. How much can you afford? That is something that you would have to ask you a question for yourself. All right, I want to buy a house. What is my plan? How much I can afford? Based on your credit score, based on your income, you would have to ask this question yourself. Make your financial plan. Basically, make a budget for yourself. And then let's see, after you make a budget for yourself, identify your home price. See how much the house that you want to buy, what is the price of it? How much does it cost you? Save towards your down payment. Friends, if I can let you know that the more payment, the more percentage you put in a down payment of a house, the less mortgage you pay monthly. And then also check your credit score. See, I think if I'm not making a mistake, and I will cover this on slides coming up, your credit score plays a big role on buying a house. And then also look for local resources and make a plan. What I mean by local resources is just like on the websites, online, when you see people like putting their house for sale or whatnot, you would need to see other sources as well. What determines the cost of the home? Basically, what determines is the location. Where is the house located? Supply and demand. Basically, like see how does it like basically like supply and demand. Like if there's a lot of house available, what is the reason behind it? It's kind of like a supply and demand chain, basically. And then the cost and the size of the land, and then also the appearance, functionality, and then other maintenance that physically that you need to do for the house. That will all determine the cost of the home. But friends, if you look at this graph that I showed it to you, as you can see that the home prices have been increased tremendously. And then from 1965 all the way to 2021. And if you can look, if you look at it, the price of the house is almost, it's very almost at 400 bar. And then we don't have the, I mean, if you look at the 2022 as of the last year, to be honest with you, look, the price of the house above 450. So we are looking at least closer to $500,000 for that, the cost of the house. Other question that you need to ask yourself is, how much does it cost to own a house? Well, here's the question for, here's the answer for you guys. Buying your home, first of all, you would have to think about the down payment of the house, the closing cost of the house. That is the two major expenses that you're gonna do. The other thing is the mortgage of the house, the insurance of the house, the property tax of the house, the utilities of the house, the maintenance and down payment for repair and appliances. Basically, what that means is, let's say that you wanna renovate your house, and you call a contractor, and the contractor will give you a quote of like $8,000, and the contractor will say, "All right, give me $3,000 now, and then the other $7,000 when I finish the contract." That is what it means: the maintenance and the down payment for repair and appliances. And then also, there's something that you have to consider is the homeowners association fee that you need to consider as well, friends. The most important one is also, as I said, the down payment of the house and the closing cost, the mortgage, and then also the insurance of the house. You have to have insurance on the house. God forbid if anything happened, if there's any flood or there's any earthquake or anything that happens, you have an insurance to cover or to build your house. It's very important to have that those things. The home insurance is covers the structural damage or from a disaster. For example, God forbid if there's a fire or windstorm, falling a tree branch or vandalism, among the other things, that covers by your home insurance. The home insurance does not cover any damages for a normal use or a lack of maintenance. Basically, like if you don't repair a pipe on your house and that could cause a very major leak at your house, insurance does not cover that because it was your responsibility to kind of like rebuild it a while ago. And then also there's personal liability, money for the lawyer, or damage if someone gets hurt on your property. For example, let's say during the snowstorm, and if you don't clean your driveway, and if somebody falls down and gets hurt, they can sue you, and then the insurance will cover if any damages that happen to another person. Also, medical insurance. The medical insurance is the expenses if someone gets hurt on your property. Let's say you have a group of friends coming in and one of them gets hurt by falling down on your property. the insurance, the homeowner insurance will cover all of their medical expenses. And then also the home insurance can cover losses of use coverage. Basically, if the home is damaged so bad that you cannot live in it, then we'll pay for it. Then basically, like if anything happens to you, or I mean, sorry, if anything happens to your house and there's no way that you can live in that house, then the home insurance will pay for your hotel until your house gets repaired. So that is very important, guys. So you have to keep in mind that home insurance is very important. Just it's as important as a car insurance. Homeowner Association, HOA, is something that everyone pays a bill. It's a monthly, it's a monthly payment that you guys do. It's for maintenance, repair, and shared services. There is an HOA rules, and you would have to look at it online, and then it increases over time. Ask if they have HOA. So if you buy a house, you would have to ask the person who's selling the house how much is the HOA and if they have it. HOA is basically it's an organization in a subdivision planned community or condominium building that makes and enforces rules for the properties and residents. So basically, it's an association that helps out with all of that stuff. All right, here's an example of a homeowner expenses. So now we would have to consider, let's say, this is just an example, ladies and gentlemen, please don't quote me 100% on that. So let's say a monthly mortgage payment for the average of like a $546,000 on a Virginia area, Northern Virginia area, and a $300,000 on Houston, Texas area. So your monthly mortgage is going to be $2,400. I'm looking at it right here, ladies and gentlemen, $2,946 on Northern Virginia, and then the same house for $300,000, it will cost you $1,503 on a 30-year fixed rate under the 6.4% interest with 20% down payment. And then on the Northern Virginia, this 30-year mortgage fixed rate is at 6.79% with 20% down payment. Then you would have to include $645 property tax, home insurance, $198. Like the cost, the Northern Virginia area, they don't have the homeowner association, but in Texas they do. So that will cost you another $52. Utilities usually is $329. Is average between $70 for water, $125 for electricity, and $74 for gas, and then at least $60 for the internet. And then same price for Houston, Texas. So your monthly expense on Northern Virginia area is $4,118. And then also all of these expenses, if you add them together on Houston, Texas area, well, that will cost you $2,561. So this example is a great example of not only mortgage that you would have to think about, but you would have to think about the property tax, the home insurance, the homeowners association, which is an HOA, and then also the utility bill, and that will be the total cost of your mortgage. But when we say make a budget, there's always like 50, 20, 30 rule that you have to think about. What is 50, 20, 30 rule? It's a rule as a financial coaches. We think that when you make your own budget, there's 50% of your budget. 50% of your income goes to what you need. 30% of your budget goes to what is the wants, and 20% should go to your savings and to your debit. So if we look at the example over here, need is basically rent, your car, your utilities, internet, gas, groceries, and personal care. And then your wants would be like eating outside, And then also entertainment, new clothes, and cable and TV. And then $750 should be at least your savings. Try to save the 20% first, and then manage the rest of your income the way you want to manage it by making a budget by yourself. When you buy a house, the mortgage company is looking something is called debt to income ratio calculation. Basically, how it works is whatever is your monthly total debt that you have divided by your monthly gross income, times it by 100, and that will tell your percentage that how much percent debt do you have. And according to my chart over here, if your debt is less than 35%, which is amazing thing, keep it at that. Do not let it increase. And then if your debt is between 36 to 49%, that means you're in a medium debt load. It means like you don't have a lot of debt. But if your debt is higher than 50%, that means you have a lot of loans or you have a lot of debts that you need to take care of that first before buying a home. That is something that you would really need to consider about, ladies and gentlemen. Down payment. What is a down payment? Basically, down payment is the percentage of a home price that you can pay upfront. The best percent that you can pay upfront is at least 20% of the price of the home. So now let's say if you want to buy a house for like $700,000, now you have to calculate what is the 20% of $700,000. Do you need to have that cash available to your account? And then if you're a first-time home buyer, it is okay to, it is absolutely fine if you want to put 5 to 10% down payment. Just keep something in mind, friends, that if you pay more down, the better mortgage rate you're going to have. Something that you would have to consider about. Let's say like if you have cash available to you and you want to pay 30%, it's even amazing for you for your monthly mortgage rate. So something that you would have to keep in mind. If you're a first-time home buyer, there's a lot of programs that you can take advantage of. Down payment assistance, also grants or loan to help with a down payment, and then usually you can put 10 to 15% down payment. That may include the closing costs as well. And then the eligibility is basically you have to have a low income, a proof of home or purchasing area, owner occupancy agreement, attend classes and coaching, credit score, contribution sum towards the down payment. And then also there's a website at the bottom that is called hud.gov. It's basically, it is something that it's given by the government. It's kind of like a first-time home assistance through the government that you can take advantage of. And that is a website that you can take a look at as well. And then also there's an individual development account, IDA account. It's another help that is provided for you guys that you can take advantage of. It usually is matching to your savings. So let's say if you have a $10,000, they can match up to the $10,000. And then you can use that towards your business, car, home, or education. They can match to the maximum amount of dollars. You would have to attend some classes and then financial counseling. They also provide all of that stuff as well. When you want to buy a house, there's something that you need to consider for yourself is very important, ladies and gentlemen. It is basically set a home price range that you can afford. So for example, let's say if I want to buy a house and I'm sitting down to myself and I'm discussing with my family, all right, if I want to buy a house, how much am I looking for? Maybe like, let's say $400,000 to $600,000. So I would look a house between that range. And then also you would need to consider the bedroom. How many garages do you need? How many floors do you need? And then also there's another thing that you can think about is what do I want to pay monthly? Something that you would have to consider as well. And then also there's a website that can help you out is www.nerdwallet.com. And you can take advantage of that website and you can read about it. And it says, how much housing can I afford? And there's a whole article that you can think about that can help you out in terms of buying a home. So now here's the difference between a low credit score and a high. A low credit score equals to high interest rate. So let's say that you want to buy a house for a $300,000 on a 30-year fixed mortgage. So now, if your credit score is low, how much interest you're gonna get, and if your credit score is high, how much how much interest you're gonna get on that. So let's start at the bottom of this chart. At the bottom of this chart, basically, if you have a credit score of 620 to 639, your APR, your interest rate is going to be 4.047%. That is monthly $1,320 towards your monthly payment. So that means that's how much you're going to pay on interest. And the total amount of interest that you're going to pay in 30 years is $200,328. Now, if your credit score is between 640 and 659, your interest rate is going to be 3.5%. So that means monthly you're going to pay $1,235. And then in a 30-year mortgage, you'll be paying $169,610. So basically, if you look at this chart, the more you pay, the higher credit score you have, the less interest you're going to pay. So that's why we say credit score is number one thing that you need to think about. Credit score is very valuable. Credit score means a trust towards mortgage companies or banks. So that's why we're saying. So now let's say if you have a credit score of the 639, you can buy a house on a $300,000. You're going to be paying $200,328. So technically, your total amount that you're going to pay is $500,328, which is $500,000, $600,000, which is a lot of money on a 30-year mortgage if you have 620 to 639, credit score. Total cost. So if your credit score is really good, and if your score credit is between 760 to 850, excuse me, the price of the home is $500,000. The interest rate is 4.5%. And then how long is the loan? Is 360 months or 30 years. Now the principal plus the interest is going to be $2,533 a month. So now, if we take $2,533 and we multiply it by 360 months, which is 30 years, your mortgage is going to be $911, $880. That's how the mortgage companies calculate your rate. Your total amount of money that you're going to pay to the mortgage company. They're going to base on your credit score. So that's how it's done. That was for a good credit score. So now let's do a bad credit score. A bad credit score is 580 to 620. So if your credit score is around 580 to 620, so now if you want to buy the same house, and your interest is going to be 6.5%. And then also it's going to be 360 months or a 30-year mortgage. So now monthly, you'll be paying $3,160. That's how much your monthly mortgage is going to be. Now, if you take that $3,160 and we multiply it by 360 months, the total amount that you're going to pay to the mortgage company with the bad credit score is $1,137,600. Basically $1.1 million if you have a bad credit score. Make your plan. Make your home purchase plan, financial plan first. For example, think about how much, what you would call it, what is the price or how much you want to buy a house for. Number two, calculate your debt ratio. We went over that. Your total debt divided by your monthly gross income multiplied by 100. Let's see if your monthly debt ratio is above 40%. Your goal should be to bring it lower than 35%. So let's say if your debt ratio is above 50%, for example, the first thing that you need to do is pay off your credit cards. And then think about down payment. So let's say you're thinking of a house that you want to pay $500,000. You want to multiply 500,000 multiply by 20%, whatever that amount is, you should be saving. And then your goal is for next 3 years or 4 years, you should have that down payment saved up in your account. And then the fourth thing that you can, the fourth thing that you can think of is credit. What is your credit score? All right, if your credit score is 658, what is your goal? My goal is to bring my credit score at least 720 until I want to buy my house. So that is kind of like bringing up my credit score. So for example, how can we do? Try to use your credit cards less, and then pay your credit card bill or any kind of bill on time. If you do that, believe me, your credit score is going to go up.